Hey, it's Jim, and this is level 1 of the CFA program, the topic on economics, and the learning module on understanding business cycles, which is a part of macroeconomic analysis. We'll have other great conversations on microeconomic analysis and international economics in other learning modules. So our focus here is on understanding the macroeconomy. Let me give you just a quick example. We're going to have a client's going to come to us and said, hey, here's a bunch of my capital, find something to do with it. Now, a lot of financial analysts are going to use the top-down approach. So we start at the top, the big macro economy, and if we pursue that approach, maybe we find that we don't like what we see. Maybe we don't like GDP estimates for growth. Maybe we don't like inflation. Maybe we don't like housing starts. Maybe we don't like energy prices. And when I say I don't mean this personally, but I'm saying that when we evaluate these macroeconomic indicators, they are not suggesting any period of economic growth. In fact, maybe they're predicting a recession, which means that understanding the business cycle, which essentially is just the ebb and flow of the size of the economy, think of it as the rising GDP and the falling GDP over time. The learning module is very careful to point out that business cycles really have no set time frame. And this is probably a good exam question as well. For example, I think in the learning module, I read a sentence or two in there that says a business cycle can last for as little as maybe a year and as long as a decade or even longer. So let's not get married into the idea that a business cycle has to be a 3-year period or a 5-year period. It is variable, which adds to the importance of understanding the macroeconomy. We're going to do lots of descriptions here. So describe business cycles, describe credit cycles, and then a couple of factors that go in to analyzing the business cycle. But there's no doubt that the business cycle here is the focus. And of the 15 or 16 problems at the end of this learning module, almost all of them are focused on the business cycle. So let's go ahead and start with the very beginning of this learning module, in which we are provided with a traditional explanation for what is a business cycle. Now, there are 3 different types of ways to explain the business cycle, but clearly this classical style is the emphasis throughout this learning module, and likely then the emphasis for most of the exam questions. So what was I saying just a moment ago? Fluctuations in GDP. The classical business cycle tends to have shorter contraction phases and longer expansion phases, but it doesn't have to be that way. Now, what I want to do is go to the next slide first, and then I'll come back to that previous slide. So here's a really good picture of this classical business cycle where, and let's just start from the left, so time is on the horizontal axis, and then changes in GDP, or GDP is on that vertical axis. And so look down on the bottom left here. Here's where we are at the lowest point of the economy, right? Let's suppose we're just coming out of a recession. So what happens? Well, we have recovery. I mean, that makes sense. That's a good word. We're recovering from a recession. And so notice that there's, that the slope of that line, it's kind of flat. It's 0 at the bottom, but then, it's upward sloping. But then notice what happens. We start increasing at an increasing rate all the way through the recovery. Then once we recover, then we're in a position to expand. And then we start expanding. So look, we're going from GDP, maybe 2% one year, then 2.5% the next year, then 3% the next year. And then we hit the peak. What happens then is that the economy is in full-blown machine mode, right? Everything is clicking. Inflation is low. Lots of people have jobs. Individuals are making lots and lots of income. They're spending, they're saving, they're doing all the right stuff. Well, it would be awesome if that expansion could go way up and way up and way up. But unfortunately, it's not going to work that way, right? This is why it's called a business cycle. We hit the peak because businesses, they cannot operate in I'm going to just call it a perfect levels of efficiency over an infinite time period. So things go wrong. During this expansion, what do we do as individual consumers? We go out and buy stuff. So maybe we'll buy a computer, maybe we'll buy a car, maybe we'll buy a house, and that fuels the expansion. But unless you're different than I am, I'm not going and buying a house in the next neighborhood. I don't need a house over there. Now, I might buy a lake house or a beach house, but the housing explodes during that expansion time period, but people don't need 20 houses, right? So we have this slowdown. A lot of times it's called a maturity phase, where we're still increasing the size of the economy, but it is increasing at a decreasing rate, and then we head back into a recession. Now, of course, those of you who read the Wall Street Journal every day, and you should read the Wall Street Journal every day, you hear the Treasury Department and the Fed, they say things like, oh, we hope we have a soft landing. We're going to pursue monetary policy and fiscal policy so that we have a soft landing. What that means is that when we hit the peak and we're on the downslope there, we never hit negative GDP. We never have a contraction in the economy. So we hit that, let's say 0% GDP growth, and then we bump back up. That's a soft landing. I'll editorialize here for just a second. I'm not quite sure if I trust our government leaders to provide us with a soft landing. Nevertheless, that's what it's called. Then we hit the trough again and we repeat the cycle. So remember, this could be 1 year, it could be 5 years, it could be 10 years. I imagine at some point in future history, this could be like a 30-year period. I probably won't be alive for that. All right, so think about this. This is just a classical definition of a business cycle in which we're trying to decide and evaluate and measure either the rate of increase or the rate of decrease in the size of the economy. We do that with the slopes. But there are a little bit more subtle ways to do this. Maybe some economists would call it more sophisticated. So let me go back to this first slide. There is the second one called the growth cycle. And this is really a cool kind of a concept because, as you know, the Institute is very big, and this is completely accurate here, very big on having some kind of a benchmark, whatever it is, a benchmark against which we can measure performance. Well, remember, in this growth cycle, what we're doing is we're looking at the growth in GDP and the variations around that long-term trend growth level, right? So let me go back here. So what's happening from trough to trough? We have, different levels of growth. Some are negative, some are positive, but we could compute, we could estimate, we could actually draw a line on there that would be long-term trend. So what we're going to do here with this growth cycle is we're going to look at the gap between actual economic activity and the trend. So there's kind of like your benchmark there, that trend growth. So I think that's a really good exam question. If I were creating questions here, I would probably ask that one here way more than this growth rate cycle. But this is interesting in and of itself. If I go back, whoops, I went the wrong way. If I go back here, so imagine we're getting up to the peak. So what's happening? Our rate of growth our growth rate in GDP is increasing, but it's slowing down. It's increasing at a decreasing rate. So imagine if we were smart enough to be able to figure out what that peak point is going to be. Oh my gosh, we could make so many great recommendations for our clients. Whoops, I went the wrong way. So that's what this growth rate cycle is. The economic cycle defined by changes in the GDP growth rate. Now, some economists will suggest that this is a little bit more of an accurate method. So look at that second block point. Peaks and troughs are detected earlier. And that is the best exam question there. So remember, growth cycle compared to a benchmark, growth rate cycle, detection of peaks and troughs earlier. All right, how about these business cycle phases? Some really good questions at the end of the learning module here. So in the recovery phase, what are we doing here? Businesses reduce layoffs. So think about this. At the bottom of the recession, it's really, what's that saying? It's darkest just before the dawn. I don't really know if that's true scientifically. It doesn't seem like it's true scientifically, but still at the bottom here, let me go back here. At the bottom of the trough, what's happening? All the businesses have decided that on their income statement, they have squeezed every last bit out of the left-hand side of the income statement, all of those expenses. So what happens then? Oh my gosh, we're transitioning to hiring more employees. We're transitioning. We're not quite ready yet, but we're transitioning. We're planning on capital investments. Then we hit the expansion stage, and that's when this happens here. We're going to say something like, you know what, let's hire lots and lots of people. Let's go ahead and make our employees permanent workers. And ultimately, that's going to decrease the unemployment rate. So then this is what I was saying earlier about hitting that peak. Sooner or later, you can't keep peaking, right? So we hit this slowdown phase. What that means then is that business activity and consumer activity are probably still above the average because we've made a bunch of money in that previous time period, but we're not spending as much, right? We're declining. Hiring then slows, and then we hit the contraction phase, and this is where the business and consumer activity is way below average. So we start doing everything that we came out of before we hit the recovery phase, reduce working hours, eliminate overtime, hiring freezes, all of those things. So here's my advice is to get your phone out, take a picture of this one, and look at the very top diamond point in each one of these. I think this is probably a good exam question. Narrowing, positive, negative. So I think that's important with that output gap. What the learning module does next is it says something like, you know what, we now understand these different phases of the business cycle. Let's go ahead and look at it from a different angle. Let's try to slice each of those phases into different components. And so an obvious component is this credit cycle. So look at the first two embedded arrow points. These are really, really good exam questions. In strong economy, so what does that mean? That means, we're coming out of the recovery and we're into the expansion. We might even be into the slowdown phase. But what's happening here? Financial institutions are willing to lend money to homeowners and car owners and students and all these different kinds of people. Businesses, right, who are looking to expand, and they do it on favorable terms, right? What does favorable term mean, or good terms mean? Probably at lower interest rates. In a weak economy, however, the financial institutions are going to say, there's lots of uncertainty out there. And so we're going to charge you for that uncertainty so the interest rates are available. And if you want to borrow $20 million, boy, we just can't quite do 20. We'll lend you 15 at a little higher interest rate. So remember that's less available. Now look at the second orange arrow point. This is a really good exam question. These credit cycles, longer, deeper, and more pronounced than the business cycles. And so what the reading doesn't do, and you don't really see this too much in economics textbooks, and let me see if I can go back here. You could try to overlay the credit cycle here, but it really is not a one-to-one relationship. In fact, it has not perfect correlation. Because of this pronouncement and the way financial institutions react to changes in the economy and how they're going to manage their balance sheets. Now, the last arrow point here, this is another good exam question. Why do we care about credit cycles? Well, we need to know about housing markets, right? If interest rates are high, if credit is less available, then we're not going to build houses. Right? This will help us understand business cycles. It might not help us with the timing of the business cycles, but it might help us with the depth and an understanding of those business cycles. And then, what did I say just a few moments ago? I editorialized, we can better anticipate monetary policy and fiscal policy. I wish I could better anticipate what the government is going to do. But anyway, this is a really good exam question. You would think that it allows us to better anticipate. All right, we have a couple of economic indicators here that are going to help us decide not only what stage are we in, but how each of these variables are going to influence the stage and what kind of questions that can show up on the exam. All right, so resource use, workforce and company costs with these expanding and contracting economies. All right, so in the recovery phase, there's a gradual uptick in resource allocation. This is what I was saying earlier about, when we're in that recovery phase, we're hiring more people. We're thinking about investing in capital expenditures. That's why in the bottom right there under recovery phase, business spending. So maybe we're going to spend in the intermediate term, but we're preparing for those long-term phases, which we're going to hit when we get into the expansion phase. Overutilization of resources, right? We're throwing everything we can with our labor and our capital, and we need to worry. We need to worry about these inflationary pressures. Slowdown phase, decline in resource use, right? Slowdown. Economic activity is above average, but we've talked about that before. But then what about this contraction phase? So our resources, labor and capital are underutilized, which probably results in higher unemployment rates. Now, let's go specifically to these fluctuations in capital spending. So in that recovery phase, look at the second one there. Capital spending gradually increases. This is what I was saying about. We're thinking about it. We're doing it a little bit, maybe intermediate term, so we're thinking about it. But then during the expansion phase, then we go full throttle into these investments in wealth increasing projects. And so what does this mean? That's going to present itself over on the income statement with increases in profitability, but more importantly, it's going to show up on the cash flow statement where we have improvements and increases in operating cash flows. And so think about this expansion phase as the firm filling up its bucket of cash flows, let's call them operating cash flows, so that it has those cash flows to make those long-term investments. Remember, we called the difference between operating cash flows and free cash flows. So look at the bottom diamond point. Heavy investments in complex equipment. What does that mean? That means, well, whatever you can imagine what it means. Not just buildings and factories, but technology, artificial intelligence, all that kind of good stuff. The slowdown phase here, we've got this relationship between worrying about inflation in the expansion phase and then a realization that interest rates are going to rise. So that prevents the overheating and encourages that investment slowdown, which is linked to what I was saying earlier about, when we buy a house during the expansion phase as consumers, we're not probably going to buy a second house or a third house. We just don't really need that. So the contraction phase, what's happening here? We see contraction for demand by the consuming public, which of course then shows up on the revenue side of the income statement. Remember, revenues are nothing more than P, price, times Q. And so if consumers have less demand for Q, they're going to buy fewer houses and fewer computers and fewer cars. Then of course that's going to result in something less that shows up on the bottom right hand of the balance sheet, and that means fewer cash flows. So think about, this is called the contraction phase. So this is the phase in which these executive leadership teams, they take a step back and they say, all right, it's been a good ride. Let's decide what kind of decisions do we have to make, like reduce spending, or reduced employment levels, so that we're ready to hit the ground when we come out of the trough and hit the recovery stage. Now, I've been saying a little bit about housing here, recovery phase, right? We're thinking about buying a house. In the expansion phase, we go ahead and we buy the house. In the slowdown phase, maybe we say, you know what, we don't need another house, but maybe we can refinish our basement. We have an unfinished basement. Let's go ahead and put a living room and a TV room down there. Or let's put an addition on the house, right? So we're still happy about the economy, and the economy is still growing, but it's not growing as much as it was. And then, of course, during the contraction phase, we have a substantial decline in demand for housing. And so that will result in all sorts of consequences in the financial institutions industry. And so, well, depending on what inflation is, depending on what interest rates are, we're going to see changes in the credit market as well. All right, how about external trade sector activity? So what does this mean? In the recovery phase, of course, there's going to be an increase in trade volumes because increases in domestic consumption. We're going up that slope, and that makes perfect sense that there's going to be higher demand for goods and services. And then during the expansion phase, that just accelerates. All right, so now what happens is that we've got lots of people working, so we have lots of people generating lots of income. And so not only are they going to say something like, hey, you know what, I'm going to go here in my locality and buy this stuff, but I'm going to go over there and I'm going to go across a geographic line into another country and I'm going to buy stuff over there. So there's high levels of this trade activity. So we're importing and we're exporting. We're doing all sorts of great things. So what's happening here? The domestic economy is expanding, right? And the international economies are also expanding. Now, of course, you need to worry about what is the relationship between the imports and the exports. Do we have a trade surplus? Do we have a trade deficit? That's a conversation that we'll have another day. Those of you who have been paying attention at all to U.S. politics will know that while President Trump was president, he was very unhappy about the trade deficit between and among some of our trading partners out there, and he instituted some policies to try to fix that. I'll let you guys decide whether or not he was successful or not. And by the way, that's probably not going to be on your exam. How about the slowdown phase? Well, this is similar to what we've been talking about, reduction in consumer spending. So what does that mean? That means that these firms are still growing, but they're growing at a decreasing rate. So they're probably not exporting as much. Are we going to be importing as much? Probably not. So slow down in exports and imports as well. And then in the contraction phase, we're probably not going to be very, very happy. Here's where in the contraction phase that if we are contracting more than other economies, we're going to have a trade deficit. So you always have to remember that trade deficit or surplus is a function of the relative size and changes in the two economies. I mean, you think about it, United States, we could be expanding at, let's say, 10%, but Canada, it could be expanding at, let's say, 20%. So even though we have this huge economic growth, we might still have a trade deficit with Canada. But remember, in the contraction phase, if we're contracting, U.S. is contracting at a greater rate than other countries, then we'll have a trade deficit. That's probably a good exam question. Inventory levels, boy, we're kind of repeating ourselves here. So think about if we're a company like Johnson & Johnson and we have all of these consumer goods. And so our customers go to Walmart and Target and they buy soap and shampoo. So what happens in the recovery phase? When we go to Walmart or Target, there's probably an increase in demand for all of those goods, which means the businesses are going to start manufacturing more soap and shampoo. So their inventory levels are rising. So look at the word there, rebuilding in this recovery phase. What happens in expansion? Oh my gosh, this is great. So these firms, they have tons and tons of inventory in their warehouses, in their manufacturing facilities. And what do? They make this stuff and they ship it out. And it gets put on the shelves at Walmart and Target. And what do? Oh my gosh, we love washing our hair and taking showers during economic expansion. So we have a greater demand for those goods. So continues to rise all the way through until we hit their peak. Now, of course, this is a big challenge for businesses to try to decide, all right, when are we going to stop expanding, right? When are we going to hit that peak? Because then there's going to be a dramatic shift in those inventory levels. So think about from the expansion phase to the slowdown phase. What's happening is that we're going to have a big change in inventory. So here we go. Slowdown. Economic growth starts to moderate. The businesses become cautious about excess inventory accumulation. Why? Because the businesses know the economy is contracting and we're not going to buy as many bottles of shampoo and bars of soap because we are making less and less money. And in the contraction phase, then, boy, maybe we don't even take baths during the contraction phase. Now look, of course, my example with Johnson & Johnson and shampoo and soap, we also need to look into the microeconomics of this and ask ourselves the question, what is the elasticity of demand for those particular products? And I'm just hoping that we all bathe during economic expansions and economic slowdowns. But you get the idea about how businesses respond with their inventories. You know, I guess the extreme example here is the automobile industry, right? Think about how many cars are sitting on the parking lot of your local Honda dealership when we're in a contraction phase. Oh my gosh, there are tons of cars there, and this is the worst thing that can happen. So what do the Honda dealers do? They say, oh, we're having an explosive sale of our inventory. No deal. Make us an offer. Come down and we'll get you into whatever car that you want. So what does Honda do? Of course, in this contraction phase, Honda cuts its production because it doesn't need to produce all of those Honda Odysseys because they're sitting in the parking lot. Wouldn't it be awesome if we could identify exactly which place and which phase and which locality we are on inside of the business cycle? Well, economists have come up with a way to try to make this determination. They call these leading indicators and lagging indicators and coincident indicators. So these are probably really good exam questions. The Institute could give you a question stem and say something like, hey, here's a bunch of stuff. Let's have return on the S&P 500. How about weekly hours in manufacturing? How about initial claims for unemployment? And the question would be, which of the following? Is it a leading? Is it a lagging? Is it a coincident? And you would say it's a leading indicator. If the question stem said, hey, how about inventory sales ratio? How about the consumer price index? You would say it's a lagging indicator. If the Institute in the question stem said, what about changes in the production inside of a particular industry, income generated on a inflation adjusted level, or retail sales, you would say, hey, that's a coincident indicator. So why do we use these things? Well, they indicate the direction and the sentiment of the economy, so we have a higher likelihood to be able to identify where we are in those phases, right? Are we up or down? So that third diamond point is probably important. Predict possible future investments. Now, these, of course, are not perfect. I mean, let me go back here to this previous slide, right? You know, we get this data. A lot of times we get this data from the federal government, and sometimes the federal government is perfect in its collection of the data. Sometimes it's not. The interpretation of the data can sometimes be left in the eyes of the beholder. Data can be inaccurate. It can be estimated. Not to mention the simple fact that GDP is pretty difficult to measure. I mean, this is how I explain it to my class. I say, look, imagine today you get a shopping cart and you go out and you buy one thing of 100 possible stores that are out there. One calculator, one bottle of water, one car, one house, 1 gallon of gas. One solar panel, so you buy 100 of these things, put them in your shopping cart, and you check out, okay? And then at the end of the next period, maybe it's a month, you do the same thing. You buy the exact same things, and you check out. Well, when you check out, what you can do is you can say, boy, that's kind of like the size of the economy. Now I'm sampling here, right? It's the size of the economy. And if I buy the same thing 1 month later, then the difference in those two prices is going to be the rate of inflation. This could be GDP here, this could be GDP there, and the difference between those two could be a rate of inflation. But it's so impossible, it's nearly impossible to try to figure out what to put in that shopping cart and what to exclude. And then how do you measure the price? Do I buy it at Walmart or do I buy it at Target? Did I buy Honda directly from the dealer or did I buy it over there? Or. So it's very, very tricky. So remember that when you use these economic indicators, you need to take them with a grain of salt, as my mother used to say. So those are the limitations here. Now, of course, economists are never satisfied when they're told that there are limitations in some of their processes or their models. So of course, it makes sense to come up with these composite indicators. So here's this OECD composite leading indicator. So look at this: money supply, economic sentiment, permits and orders, an equity index, interest rate spread, manufacturing and service sectors. And so rather than just take a look at one let me go back here. Taking a look at one of these, or maybe a handful of these, what we do is throw them. Think about it in the following way: throwing them into a portfolio. That's what a composite indicator is. So remember this OECD composite leading indicator. There are surveys. Lots of economists like to go out there and say, they interview people and say, hey, tell me what you think. There is a super popular think tank called the Conference Board that has come up with this Conference Board Leading Economic Index. And this is comprised of 10 components. You won't be surprised what these 10 components are. Look at the first two. There's a new order index. There's new order for consumer goods, weekly hours, more weekly initial claims, interest rate spread. So that's an important one, difference between the 10-year Treasury yields and some overnight borrowing rates, a credit index, there's stock return index, permits, new orders, average consumer expectations. I went to the Conference Board's webpage and I want to read this to you here. This is what it shows right at the top. The leading economic index provides an early indication of significant turning points in the business cycle and where the economy is heading in the near term. So I'm guessing that a good question on the exam would probably not be, identify these 10 components, although there's one or two questions at the end of this learning module that ask you to do identify those. But I like this thing right here. What did that say to us? An early indication of significant turning points. That's what I would remember about the Conference Board and the leading indicators. Now, how about big data and nowcasting? What was I saying earlier? That the federal government, sometimes they're right, a lot of times they're right, sometimes they're not right, but there's a big lag. And so this concept of nowcasting is really interesting, and there's a great question at the end of the learning module on this. Suppose that the federal government comes out and says, last month there were 100 housing starts. And so what they did is they somehow computed that number, however the government does it. And then over the next week or two, we learn that there was an increase in those actual housing starts rather than the estimate that the government came in. So the nowcasting comes back and says, oh, you know what? That number was 100. It should have been 105. And boy, that may completely change our attitude towards, all of these macroeconomic variables. So look at that second sentence there. Real-time insights and harnessing data. So we have a learning module on big data. So think about all of this data just in my simple example about housing starts. I can walk around my development and my neighborhood and I can count the number of housing starts. Of course, that's some indication, but how does someone walk around the entire United States? Well, of course, this takes time and resources, so real-time insights. So yeah, timely estimates. And down at the bottom are some examples of nowcasting applications. What are the benefits? Right, analysts gain a more nuanced and dynamic understanding of economic fluctuations. That makes sense. Quicker and more informed decision making. So the 1 and 2, they probably go hand in hand. And that takes us through this economics learning module on business activity. I want you to go to the end of this learning module, and these are really short questions, so you ought to be able to work through them in less than I'm going to say less than 20 minutes or so. So thanks for watching. You have a great day and good luck studying.